Hi, welcome to my weekly fundamental video. I'm going to start the video in the usual way, by looking at the difference between the three assets that we study, which is the JER30, the S&P 500 and the FTSE 100 or UK 100 as it's known on eToro. This video is then going to go on and look at I've got a few questions basically this week on how I trade and everything like that, so we're going to look at exactly how I use this difference calculation to trade and everything. So we're going to go on to look at that, and then the third part we'll look at the past week's news as we usually do, and then the last part we'll look into next week as well. So yeah, that's the layout. So this is the difference between the JER30 and the S&P 500. So as we can see, we started the week pretty much together at zero. I think it was just under zero at -5, so the JER was just underneath the S&P 500. But as you can see on Tuesday, so this is Monday, on Tuesday the 17th, the JER went above the S&P 500 quite a lot. It moved quite strongly. They came back together, two big moves, and then this Thursday we came up here and we stayed pretty much the same Thursday and Friday. So if you look at the UK 100 and the S&P 500, as you can see we started off further apart at -180, and we got them moving a lot closer together on the Tuesday, moved slightly further apart on the Wednesday, slightly close on Thursday, not much change between Thursday and Friday again. So yeah, that's how they've moved, and we'll come to back to this later when we discuss this week's news and everything. But yeah, let's take a look at how I actually use these. So we're going to bring up some spreadsheets now. Alright, so at the moment, this is the spreadsheet I use to calculate the difference. This may look like a lot of numbers, not much meaning. But basically, let's take Friday, so the 20th of the 11th, 2015 as our example. The S&P 500 closed this day at 2089. The FTSE closed the day at 6,334. So those are our two closes. Now what we do is I take this figure and I adjust it. This is the adjusted figure here, and these columns just calculate volatility to create this number so that we can get them the same. Yeah, this is what we adjust it by, so we times it by 2.0159 to get this figure of 42111. So that's we time the S&P 500 by the adjusted figure to get this figure. We do the same again for the FTSE. We get 6334, and we do the same calculation of the volatility, and we get 0.6649 as our adjusted figure. Now this equates adjusted price of 4211. So we take this price, times it by here, and we've got an adjusted figure. This means we can compare these two figures much easier. And now, as you can see, we take it away from the mean. We take the adjusted figure away from where the mean price is for the S&P 500 and the FTSE 100. This is to further adjust for volatility. This is so we know exactly how they are in relative terms, and we get the figure of -150. As you can see, this is the graph we had on the slide, and this is 115 here, this point here. So we graph that, we get -115. So that simply tells you how to calculate the difference, how I calculate the difference rather. So what do we do this figure? Because I do indication posts and I tell you this figure, but what do you do once you got it? Well, for that we have to bring up the second spreadsheet, and this is this. Now this is for the DAX. I'm just going to put that on the S&P 500. Sorry about this, there's some reason I'm away so I can't click on it. There we go. So this is the S&P 500 and FTSE. So this figure here is the difference. This cell goes and gets the difference from this one we just used. So it goes and gets this figure from here and puts it in there. And then because we're working out percentage differences, it just gets normalized. So I put it into positive terms, just treat it as a figure rather than as a negative and a positive. Alright, this is the interesting bit. This is where I calculate the probability that they can come back together. So minus 115, we can say there's a 68.6342% chance they'll come back together. Now how is this calculated? Well, to do that, we take a look at them. We create a normal distribution. Now this is a normal distribution, as you can see, and it shows you how many, how often do they go into this point. So they're minus 583. The difference between the two assets is minus 583 10 times. It's been there 10 times over the tested period, so it's been that far 10 times, and that counts as 0.38% of the time it's behind. So as you can see, and that's how we work out the probability. So we put this figure, minus 115, into the box, which would be this one, because it's in the box of minus 203, and we work out how often is it in there. It's in there 7.63% of the time. Yeah, we then want the probability that they're going to come back together. We times the we just take this normalization figure, and we work out where it is in this box, because as you know, that's minus this 13, which is the midpoint, and minus 115 lies between these 2 points, minus 13 and minus 203. So we want to know the percentage between that 115 is between these boxes, and then we times it by that, and that's how we get this probability figure, PS figure. What that tells you is it's 56% of this box, so there's a 56% of 41.26%, which is about 20.5% along. We then add all these percentages below, and that tells you the chance that they'll go further back. Sorry, we don't actually add it all. That's my bad. I should know that off by heart. I do know off by heart, but we add, all these percentages here. And this, what I was getting confused about, this tells us what's the probability they'll come back together while going our way. Because if we're long in the FTSE, because the FTSE is below, that's the negative figure below the SP 500. We want to know what's the probability of them coming to get back. So we add them all together. You see the probability that they'll go this way, and as you can see, there's a 68.63% chance that they'll come back together, which means there's almost 70% chance we can get the trade. What I then do is calculate the maximum difference. What is the maximum position they can go to, like as far as apart as they can. What we can see is there's a maximum difference from this point of minus 11.11%. This makes it so that if we would take this trade, we would have to risk 6% on each side and have a 70% chance of getting the trade, which some people might like to take. I think that's a lot of risk, quite a low probability, especially for this strategy, and quite a lot of risk. So we didn't take that one. What we did take one though is on the S&P 500 and American Express. So I'm going to talk you through this trade that I've taken. This is a good thing about doing these videos. You can notice things you have done wrong. See, that's American Express. So once again, if I show you the one where we work out the difference, I can bring up American Express down here. Now it's calculated in very same way. So we've got the 28009, times it by the adjusted figure to get the adjusted price. We've got the 72.42, times it by the adjusted figure to get the adjusted price. Take them away from me, take them away from each other. Minus 84. As such. And we get minus 84, and then once again this cell takes that minus 84 and we normalized it to make it into a positive. We then take the probability, work out how much, or 84.47 is of this one this time, because we're in this set, because this is minus 59 but this is minus 84, And this is, if you know what I'm talking about, you're good at maths, you'll know why this was such a good trade by that. Because minus 84 is bigger, sorry, smaller than minus 59. It lies out. This means that actually it's never gone this far apart on the data used to calculate this normal distribution. So it's quite a strong trade, and as you can see, it's given us a probability of 103%. This is 1.003, but it's not in percentage terms. So yeah, and yeah, overall risk, because the way this is calculated, this thinks we can put our stop losses above the entry price. So as you can see, our actual risk is to make a profit of 2%. So this is why we're taking this trade. It's a strong trade. But yeah, I mean, I know that's slightly complicated and everything. If anyone has any more questions or any questions on how I do this, then please ask them. I hope that was clear. But yeah, let's go. Let's take a look at the news now. Let's go to the news. So yeah, we couldn't really talk about the start of the news without start of the week news without talking about Paris. I mean, I'm sure everyone's shocked about what happened. And it was obviously quite a traumatic thing to happen, both for those affected directly and indirectly affected, just I mean everyone. So yeah, we've got to ask the question, how did this affect the markets? And I mean, during trading hours we didn't see much effect. This is the gold daily. As you can see, we're showing the chart of this because gold's obviously a safe haven. People, when you're scared, you buy gold, and it's good store value and everything. So, as you can see, on this is Monday here. We did see a rally up, but it did come back down. Oh no! This is quite usual for a terrorist attack, actually. Usually when they happen, there's a sharp flee to safety, as you can see by the candlestick up. But then people don't take it as too scary. Then these things are quite one-off and everything. But it came back down again, and we finished like this, as you can see. And this was similar for indexes. So if we take a look at the S&P 500, for instance. So this is the daily chart of the S&P 500. As you can see, we opened a lot lower. People were scared, flight to safety into the gold. But look, incredibly strong back up. Incredibly strong. Either because people just saw this as a great buying opportunity. You got a really slow open, and yeah, it's a good buy, and they just bought it. People weren't too fearful. I mean, so it's a traumatic attack and everything, and so on. And I did get a question actually from Waylander51 on how terrorist attacks affect the markets, and I thought I'd just cover that quickly in this video. Yeah, so the reason why is because predominantly people get scared. If you're thinking of opening a restaurant in Paris and you've got this fear maybe of a potential bomb going off in your restaurant or someone shooting it up, that's not going to be good for business, to put it quite bluntly and shortly. People get scared, then they're going to be worried. This can lower investment. It can also lower consumer demand. You've got to remember, people now might think twice before going out for dinner. It shouldn't hold it back too much, but it might hold it back. People get a bit anxious. And then you've got like things such as the damage to tourism. Does Paris look like such a nice romantic weekend away after these attacks? I don't know. I mean, these things do happen sometimes, and people do get along. People get along in life. They move on. But yeah, that's why we saw the open low, because that's how the attacks affect the markets. So we did see it open low. And yeah, and to be honest with you, look, I thought this would play out more so. I didn't think it would happen all week, but I thought we would at least have Monday down, actually, especially on gold. I did actually buy a small bit of gold, and I thought this would be stronger for the 2 days. Maybe come back up here. I think I was aiming for just above here, but we didn't happen that. And in a way, there's a slight silver lining to me losing that trade, which was the world's getting along with itself. So a bit of positivity there and everything. Yeah, and I mean, we've got to look at the resulting effects from these attacks, like how they're going to play out. And the answer is you've got to assume that ISIS and jihadist terrorist groups in general know what the effect of these attacks will be, and that is that they're going to cause a response from at least a nation that they attacked and other nations that stand by that nation, such as NATO in general. And that's what we saw. We saw them all stepping up their attacks, and arguably that's actually what ISIS want. What they really want, in my opinion, is for NATO, such as countries like UK, America, France, Germany, Italy, so on and so forth, to put some troops on the ground, basically. And the reason they want troops on the ground is it's a lot easier to fight troops than it is to fight planes. They want to maximise their impact. They want to seem like a strong state, so they want to fight their enemies. At the moment they're just fighting themselves, really. They're fighting other Syrians and other Muslims predominantly. I mean, I know that's part of their mantra, but what they really hate is the West. I mean, that's what it's all bred out of. So they're really trying to provoke a response from the Western powers, and Russia, of course. They blew up a Russian plane. So that's something to think of. And unfortunately, the case is that could actually lead to more attacks. That aim of getting troops on the ground could lead to more attacks. So it's something to be a bit wary of, and it's a bit nerve-wracking, I know, but hopefully our security services will do the job and everything. But something to watch anyway, something to be aware of. Now, so we're going to move on to kind of more economic-y stuff rather than I don't know how to explain it. The rough scene of geopolitics, as it say. And we're going to go on to EU inflation. So we're going to bring up a chart of the euro dollar. So just give me 2 seconds, because I have not come prepared and got that up, which is very bad of me. Here we go, euro dollar. Here we go, euro dollar. So we're going to talk about inflation, a little bit of inflation, a bit of positivity. And EU inflation came out at a year-on-year basis at 0.1%, and this was compared to an expected fall of minus 0.1%. The data was released on Monday, and despite this, we saw a weaker euro. Where's Monday? This is Monday. This is Monday. This bar here is Monday. See, it's gone down. So we saw a weaker euro. And I mean, arguably, yes, this is due to the Paris attacks. That was one of the driving forces. However, I think this was given even more of a push by the inflation, and that's despite the better than expected. It was mainly due to Draghi's comments. Draghi loves to push the euro down. He loves his QE at the moment. Really on fighting times with it. And basically in his speech he stated that he doesn't see inflation making a sustained recovery. So what he's saying there, despite the 0.1% figure, he's saying that's not going to sustain upwards. Might sustain at the level, but it's not heading up towards their 2% target. So I agree that those two forces is what drove this down. That's quite a those two can move currencies, both of them on their own together, and I agree that's what we saw in the continuation through Wednesday. And that also affected the German day. So let's bring up the GER30, and I made sure to put this GER30 in because Creative Vision was asking for it last week, and I felt a bit bad that I wasn't able to meet the requests of my followers, so I made sure. But here we go. And as you can see, once again, we opened low because of the Paris attacks. But this talk from Mario Draghi straight up, bang, Monday, bang, yeah, and it kept rallying. I mean, there's nothing. There's a lot of bullish news. I mean, there was a report out this week that said European equities in general were one of the most overcrowded trades over the short US dollar. So long dollar is the most overcrowded, and European equities is very crowded. Arguably, that's a risk to people buying these equities. But I mean, at the moment there is risks, because obviously once people start taking out profit, I think this could tumble. But I mean, you're really trading with the ECB and with the fundamental news. You got a lot behind you, so at the moment that's fairly justified. But remember that it is overcrowded. A lot of people are pumping money into this, so watch that anyway. That's something that's quite interesting. Yeah, and another thing to note, especially on the euro dollar, so if we just get that back up, because this is because currencies do tend to overprice things. They get a bit of news and they just bloody fly. Sorry if that counts as a swear word. Oops. Yeah, Draghi stated that in his ECB press conference, what sent this boom down here like this, that he will do anything under his powers. And the thing with comments with this, like this, and currencies, is that people start to think that they will literally do absolutely everything. So we're not talking about just a cut in the interest rate for banks, which is already in negative territory. We're not just talking about cuts to that of like another 25 basis points. Currencies just take that as a sign they're going to cut it by like I don't know, like just be ridiculous, like 100,000 or something, so you can't actually possibly keep money. So that's something to watch, because how is he going? The question starts to come: how is he going to meet all these expectations of what he's going to do without, just completely destabilizing confidence in, the European area ever getting better? He can only do so much. So that's something to watch. It was like when we had the BOJ the first time they started their quantitative easing program. We got the massive rally, which we can actually bring up. It's probably best if I bring that up. Give me two seconds. So yeah, this is the euro yen, and as you can see, what we're talking about is here. It's this massive rally we saw. It was back a while ago, 2014. It wasn't that rally. That was this rally actually. So it's rallied so much. Yeah, back here. Seems like a long time ago now. It wasn't really that long time. But yeah, we saw this massive rally, and this was before they even did anything. This was just them provocating. This is them saying I think it was March they started it. They said it sometime like midsummer. They said, oh, we're gonna do Q. We're gonna do this massive. I think it's 85 trillion or something, billion. It's a massive program. We saw a massive rally. They hadn't even conducted it. And once they announced it, they pulled back. Just pull back, because people started overpricing it. They really started thinking they're going to do more. They're going to have to do more. Everyone knows what they're going to do. They're going to have to do more. They didn't do more. Comes back, bang, pulls back. Once again, this brings us back to the euro dollar. Selling off. They're going to do more. They're going to do more. Could we see a bang back up? Furthermore, as stated earlier, this is the long dollar, one of the most overcrowded trades. Bang. So, this starts to spike back up. A lot of people are going to get hurt, and a lot of people are going to start cutting position sizes, closing positions. See it back up here. Yeah. But yeah, so that's just Europe. Anyway, Europe on Monday. And on this day we also had UK inflation. So just get a chart up of the UK 100, and I've got this one open. I've been slightly more well prepared for the UK, and as you can see, here's the UK 100. Yeah, and this was released at minus 0.1%, and this was on Tuesday. I say I was prepared, wasn't too prepared. Yeah, so this was on Tuesday, minus 0.1%. That's a year-on-year figure showing prices falling. Yep, the figure was that was an expected fall as well. And an important thing to note is the figure was continued to be pushed lower by food prices as supermarket groups battle for market share through price. This is arguably due to these German shops such as Aldi and Lidl's have really taken off in the past year to 2 years, and it's really caused a headache for Tesco's and Sainsbury's because they can't compete. I mean, they're cutting prices. Even Morrison's is struggling. They're cutting prices and everything to try and get people through the door. But what they've been left with is a position whereby they've invested huge amounts of money, but now no one's going to these huge stores that they've invested in. So yeah, so food just keeps getting cheaper, which is good if you're hungry. But yeah, let's take a look at the effect of the inflation figure. So we're looking at 9:30 on a Tuesday, and Tuesday was the 17th. And as you can see, where were we? Tuesday was the 17th. Sorry about this. Yeah, and yeah, where's 9 o'clock? Bang. Yeah, not much happened. Not much happened on the UK, which is interesting. Yeah, so why did nothing happen? Well, it came out on target, minus 0.1. It's not very exciting. It's not great because it's deflation, but the UK economy has been going in and out of deflation for years now. It's just not that exciting, really. We got sideways moves really from there. Tracked a bit higher, tracked a bit lower. I mean, the machines might have been trading this, but I don't know if any humans could have really been behind this. So yeah, that was UK inflation, uneventful, but interesting anyway, because yeah, supermarkets going down the drain. Anyway, let's go to Germany, and we had Germany economic sentiment out on Tuesday. So let's get the GER 30. Here we go. And this caused some more interesting. This was the Tuesday. We had this out, and yeah, the German economic sentiment grew in November to 10.49 from 1.9. The release is an indication of how the German economy will do over the next 6 months. It surveys economic analysts, and as you can see, it helps sustain this rally. We had obviously the Paris and ECB comments here, and then we had the better than expected economic sentiment, kept pushing it higher. And it's quite interesting because with the ECB and Germany, like the ECB's got to think about the whole of the European Union, or quite by its very nature, whereas Germany can be quite a strong economy on its own. So where the European Union might have to do more QE because of other parts of Europe, yeah, the German economy might do good, which is bullish because the better the German economy, the better the stocks look, and then the more quantitative easing there is, the better German stocks look again, and yeah, so we've got a hefty rate, and this could continue. But once again, stressing the downsides because we always got to remember your risk. Imagine if it turns around, the ECB, I don't know, down the line they stop doing their QE, or they provocate that they're going to stop because inflation is coming back, or maybe they don't do as much as expected in December, and then German economy start doing badly. Yeah, it could easily come back around. But I mean, it's quite a nice line anyway. I think this is a fib. We're learning stuff together here now. So I don't usually use these ones. Where's my fibs? There's my fibs. Yeah, this is... Oh no, it's not quite a Fibonacci retracement. That would have been better if it was down here. That would have been really nice. If you don't know, these are Fibonacci sequences. So, yeah, so these are just like technical ways of taking in sentiment. But yeah, we didn't quite get it back down here. I thought it was just looking at it, but nah, I was wrong. Sorry about that. Wasted a bit of all our time, but a learning experience altogether there. And now let's go to America, because Tuesday was quite a busy day because we had American inflation as well. It's all popping off, and this is the S&P 500 daily, as you can see. Yeah, and American inflation was released at 0.2% year on year. That's positive 0.2%. despite it being estimated at 0.0%, so that's a beat of 0.2%. Yeah, this led to a rally on the release. I could be showing this will be taken as a it led to a rally. Let's just take a look at the rally. What day is this? Tuesday. And we're looking at 9:30. Just approach this one. Yeah, so here we go. 1:30, not 9:30. Here we go. Yeah, not much happened really. Yeah, it's a bit. Yeah. We tracked a bit lower. I mean, on the release, not much. American stock market's open. This is 2 o'clock. This is when, like, the Nasdaq and the S&P 500 normal, not futures. This is obviously the futures, isn't it? So this is when this opened. This flailed down. Arguably because it's I mean, I don't know really why it fell. I would have thought that would be bullish. I'm just trying to think about it now. It's like to rise, although it did come back. Yeah, maybe if people took it as a sign that the Fed were less likely to rise, thus they took that as negatively, like it's negative for the economy if the Fed don't rise, and that's what led that lower. But yeah, man, I mean, there's no real argument either way on that figure. It's just 0.2%. I don't think it's positive or negative for the Fed. They would like if it was higher, like maybe 0.5 or something. It would have been more likely that raise. But that's the thing with this 0.2% figure. In my opinion, it's kind of nothing. It doesn't sign either way. Like, a negative figure would have obviously spurred the Fed to do more. Higher than 0.2 would have spurred them to do less, or i.e. raise interest rates. But yeah, so overall, inflation, usually a fascinating subject. Didn't really do much this week, sorry. Yeah, let's go to Wednesday now, and the Fed minutes, so we can stay on this chart. And look, bang, we got some action, yay. Yeah, so this was the release of the minutes. Look, we've got some nice rallies. Look at that, bang. I mean, there was little new information from the Fed with their minutes, but it did reaffirm the Fed are looking to hike in December. And there was quite a lot of volatility. If we look at the US dollar, we can show that there wasn't really much change in what they meant, what they saw happening, or what they're going to do. If we look at Wednesdays here, look, this is the hour when it was released. It went up, and it went back down, and we finished slightly up on the hour. 7 o'clock, up and then down, finished the same. Not much. Well, what does that mean? It means there was no change. People were looking for something to go on upwards. Didn't really have anything, and go down just because they didn't do anything. So people could take it either way. Like they were just throwing out arguments and throwing down arguments. But yeah, overall though, it did lead to a rally upwards. I mean, it's because people are probably taking a rise in December positively. It's positive news for the US economy because the Fed are viewing it as a good, you can finally raise rates. They're finally comfortable with the US to raise their rates. So yeah, we could get a rally. And now, yeah, so we flitted through most of the week. So let's go back to our difference. Let's see how this played out on the difference calculation. So let's pause that. So yeah, with that news, we can get an even better understanding of what caused the difference between the J30 and SPX 500 style. As you can see on Monday, and as discussed before, we had the that kind of good data out of good analyst opinion on the 6 months future for the German economy, and this was on top of ECB comments and the positive reaction, which is a bit of a strange juxtaposition to the terrorist attacks. Yeah, so the German they move ahead of the S&P 500. We then got them back together on the back of the Fed minutes. Fed strong rally on the S&P 500 after Fed minutes, bringing them back together. So yeah, that caused this kind of triangle shape. And let's go on the FTSE. Yeah, the difference got closer. The rally between Monday and Tuesday was stronger than the UK 100. I agree with this because the UK 100 was much lower than the S&P 500 at a starting point. It was also, if we just take a look back at this one, lower than the German 30. Because obviously the German 30 and the S&P 500 on Monday were together. Obviously the Ger 30 was above here at the end of Tuesday, but the UK 100 was below both of them. So this arguably shows you as the best buy, and that led to a strong rally between the 16th and the 17th, because it was a good buy and everything. We had the inflation, but didn't really cause too much. We then had the Fed minutes where they got further apart. So the Fed minutes caused the S&P 500 to rally, and they got further apart because the UK 100 not much action, so they got further apart. A very similar move to this one. As you can see, there's similar triangles. If I just flick back quickly, you see them. That's wicked. Alright, wicked. Yeah, so we're gonna go on now. Yeah, so this is S&P 500, and I mean overall Thursday and Friday were quite quiet. Well, an interesting thing here. I thought this was fascinating. This little doji. I thought this was going to cause some bigness, some big moves, but nothing. Like, we rallied the next day. We got a similar case from the Ger 30 daily chart again. Side, nothing. There was no real major news. I mean, we had the Malay hostage takings. And this showed a continued push by jihadist terrorist group. I think Al Qaeda claim that you're responsible for this one. Yeah, I mean, we discussed them, but Marcus didn't really seem to react. Thankfully, always, I don't know, it doesn't really sit with me well sometimes when these things react to these things. But yeah, you know what I mean. Got a small rally, so not much news there. Not much excitement. I mean, even the euro dollar was fairly quiet. It's daily. Or was it that quiet? Maybe not. No, yeah, it was fairly quiet. I mean, we've got some big moves. Once again, this is a very overcrowded trade, so it's quite volatile. It's got some moves. You know what I mean? UK 100. Daily. Yeah, look at that. Exactly the same. This is a candlestick shows indecision anyway, because it went up and up. We've got two of them, so over 2 days a bit of indecision. Not much happening. So yeah, well, I think we're just going to turn and look at the end of the week now. So next week, sorry. So yeah, this is next week. We're coming to the end of the week, so we've got some end of the week. We're about to start the week. As you can tell, it's Sunday for me. Yeah, I mean, next week, we're coming to the end of the month, sorry, so we have got some news, some big news, and it all starts with market manufacturing data out of Germany, which is tomorrow morning, 8:30, bang, nice way to start the week. As discussed before, German positive data causes rallies, and so does the ECB, so once again, some more moves, although we did see some moves. I don't know if it's going to still have such the same kind of drive, but if there's a strong data, bullish, bang, up. And US existing home sales, I quite like looking at home sales, that's why I put it in. I think it's a good guide to, the real economy, how people are feeling, people move house when they're happy. Yeah, if you start a family when you're happy and everything, buy a new house. So yeah, that's always a nice one to look at. Monday, 3 o'clock. German GDP data. This is the first bit of GDP data, and this is out Tuesday, 9 o'clock. Once again, similar to this. ECB, good German data. Happy days if you're a bull, if that all comes out well. If it doesn't come out well, we start seeing some winding. One to watch. US GDP is on Tuesday as well, so that's in the evening. So that'd be quite a big day if you got euro dollar trades on and shit and stuff. So yeah, watch that. Yeah, I just said stuff. So yeah. Yeah, and then we got durable goods orders on Wednesday. These goods. Watch these. Got Japanese inflation rate on Thursday. 11:30 unemployment. Japan have been thinking about doing more QE. Investors think they're going to do more QE anyway. They didn't last time. Yeah, so watch these. Inflation is always pretty poor in Japan. Unemployment rates are right, so yeah, remember that for inflation, because you're going to have to see something really poor. We've got UK GDP on Friday at 9:30 in the morning. Yeah, that should be good. Yeah, man. So we've got quite a good week ahead of us. Yeah, I think I'm gonna go to bed, but yeah, I hope you found this video informative and stuff. And once again, if you have any questions and comments or just anything at all, man, just give us a comment, a shout, or whatever, and I'll be happy to help and everything. So yeah, have a good week and everything. Have a good evening and good luck trading. Bye bye.